All I'm saying is buckle up, because this could easily turn into one of the craziest weeks ever, as the market awaits PCE data, earnings from two AI sensitive names, GDP data, auto sales, ISM numbers, construction spending, and University of Michigan sentiment. And to top it all off, Friday is the first trading day of March. So we are going to be talking about all of it, the good, the bad, and the ugly, and how to navigate this critical week together. Let's get into it. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell. Like this video, guys. Let's get into it. Looking at the daily heat map, there was no real rhyme or reason to today's trade. Some of the mega caps outperformed, some others didn't. Look at Amazon, look at Nvidia, look at Microsoft. Apple got quite a bit up on news it's ditching its EV division and pivoting towards AI. The market really tended to like that, and Apple have been a laggard in the AI space. Utilities was the best performing sector, but it wasn't a defensive rotation. Look at healthcare, down on the day. Look at staples, probably flat on the day. All in all, a very mixed day. Market looking a little skittish ahead of the PCE print, but we are seeing some of retailers right here perform really well. And we do know that quite a lot of retailers are actually reporting earnings this week. Now, looking at the sector analysis, utilities and regionals put out the best day so far by a long mile, and then followed by metals and comm services. The worst performing sectors were energy and GDX, as well as semiconductors, and then healthcare. Those are the only four that put up negative days. Every other sector was probably flat, if not slightly in the green. And yeah, it was truly just a very mixed day of trade. There was no real rhyme or reason to today's trade. There was no real leader. I mean, apart from utilities, all the market is doing is just awaiting PCE data. Now let's hop on the charts. Now, hopping on the charts here, you can see a couple of notable things. All the major indices, S&P 500, Nasdaq, midcaps, S&P 600, RSP, they were all green on the day, some more than others. The RTY Russell 2000 put up the best and biggest day, 1.36%, and that's because regional banks and biotechs put up a very strong day, and the Russell 2000 is like 25% biotechs and regional banks. But looking at the S&P 500, looking at the daily chart, just zooming in here, you see quite a number of notable things. But if we actually have a look at what we did on the day, we sort of like opened, moved a bit higher, came a bit lower, and then moved all the way a little bit higher in today's trade. That's exactly what the trade looked like. We actually got a lot of buy side support at this level right here, 50-50, which was sort of halfway or at the top of the 1/3 of this green candle. This green candle was the Nvidia gap up and go. So we are starting to see buy side support come in at the 50-50 area. Now, let's say this is to be a low. That's very bullish, because we then put in a low, higher low, higher low. If we then go and break these levels right here, especially this wick, we're then going to be looking at like higher lows, higher highs for the S&P 500. That's just constructively bullish. If you're making higher lows, higher highs, that's just bullish price action. There is a very real possibility that we do actually move lower upon the PCE news. But do note, with the PCE print, if we don't go ahead and break, and I mean a close below this level right here, I mean, just look at it as an opportunity to buy, especially if there's a lot of buy side support. Let's say we do gap down on PCE news, we get a bad data print, and we form a candle that looks something like that with a long wick at an equal low. That higher low is your signal to buy. If we do get like a daily close below this wick on the PCE data, things are looking a bit dicey, and I will update you on the charts. But as it is right now, those are all hypotheticals, and based on this chart, based on where we are, based on all these other candles, the positioning, the location, the fact that it's a green bodied candle, it was green for the day, supported by mid caps and small caps, I would say that this right now is looking more constructively bullish than anything else, and we should probably look to these levels first, then we should actually look to these levels right here. But PCE is a big macro event, and it's something we should be wary of. Now guys, we have PCE data on Thursday, a very important print considering what CPI and PPI did last week. Now, core PCE, according to the Bureau of Economic Analysis and Bloomberg, core PCE is seen rising 0.4% in January, which will take the annualized metric above the Fed's target. The Fed's target is 2%, as you can see right here. If we get a 0.4% increase, that's going to take us to a 6-month annualized basis of 2.4, a 3-month of 2.6 above the Fed's target. But this is a bit misleading, because they're not looking for 2.6% or 2.4% or 2%. They're looking for about 2 to 3% on the lower end of the 2% range. And seasonal adjustments, November, December, January, can skew inflation a bit to the upside. So we want to see what this number comes in. But if it does come in hotter than 0.4%, that's going to be a little bit worrisome. Nonetheless, instead of trying to predict what the data is going to do, it's best to have an expectation expectation and then react accordingly. One thing we are seeing is that economic outlook brightens for 2024. This was a survey done by Bloomberg, a monthly survey. Almost all of the metrics have increased into February. GDP was sitting at 1.5%. People are now expecting 2.5%. The same is true with consumer spending, private investment, and government expenditures. But this does overall support a stronger and brighter economy, especially for the rest of 2024 at the very least. Over the last month, maybe 6 weeks, we actually have seen yields rising, but it isn't driven by hawkish policy. The rise in yields have been driven by improving growth expectations. So you could see here that we got this amazing chart from Goldman Sachs, and they got growth shock contribution, policy shock contribution, and what the actual yield is. And you could see that over the last 5 to 6 weeks, the majority of the rise in yields have come from growth. In other words, a stronger economic backdrop versus this, which is yields rising because of hawkish policy. Very interesting stats right there. Now, we also got some more stats from Goldman Sachs, and they say equity strength broadening out is happening beyond US mega cap tech. And we can actually see this right here. This is very, very interesting. The 1 month returns of the HSI, Eurostoxx 50, China A shares, Nikkei, the S&P 500, and the Nasdaq is very, very interesting. You can see that the S&P 500 and the Nasdaq US sectors have produced the lowest 1 month return compared to Japan, China, and Europe. So we are starting to see not just a broadening out in small caps, mid caps, and other sectors, but in the global economy as well. And that's because the global economy is actually holding up really, really well, particularly Europe and especially Japan. China, though, most of this has to do with Chinese regulators just trying to support the stock market, and that's why we're seeing outsized returns in the last month in China. The reason why we're seeing such great growth contributions throughout the rest of the world, especially in China and Europe, has to do with earnings. These are 2024 revisions. We can actually see that topics right here. So the Japan index in Tokyo, the topics index, look at revisions. From about May 2023, we've actually seen an upward slope in revisions. Europe, we've actually seen very mild downward revisions, and do take into consideration that revisions, right, do actually go down. Analysts will say we're going to expect growth 10%. It's actually going to come in at 8%. We normally do see revisions downward. It's just how much. When you see stuff like this, revisions upward, that is absolutely crazy. That's fantastic. Or even just like sideways revisions like we are seeing in Europe. It is looking a bit rough for emerging markets, but they are harder to predict, and we can actually see that the S&P 500 as well, following Europe in a way of speaking, very much similar to the returns we're seeing in Europe in terms of revisions to overall trend there in the S&P 500. And that's why it's performing really, really well. Earnings are coming in good, especially for the S&P 500, for Japan, and for Europe as well. Something that's also supporting the global economy is that we're starting to see early signs of a rebound in the global industrial cycle. This is globally manufacturing PMIs and new orders, and you can see that we sort of bottomed out here in 2023, mid to late 2023, and we're now approaching back above this 50 line, which is expansion territory for manufacturing as a whole. And this is going to support industrial stocks, but not just industrial stocks, all stocks that require some form of manufacturing, and that could be in tech, that could be in comm services, that could be in discretionary staples, anything and everything. A rebound in PMIs is really a great growth contributor to the global economy, and something we really want to see, and not just want to see like on a once-off basis. If we can get sustained levels above this 50 for a while, that's really going to support global stock markets. And this is why we've been getting exceptional growth in the global economy, because economic surprises have come in so much above expectation, especially the US. Look at the US Map Surprise Index. You can see that from about October 2023, we've had exceptional surprises in the economic policy. We've crushed the inflation numbers, retail numbers, consumer spending numbers. Everything has come in above expectation. It's been a beat in a good way. We have seen that tick down ever so slightly, but we can't just get economic surprise after economic surprise. And let's be real, anything above the zero section right here, that's good. So even this ticking down is not necessarily a bad thing. Now, Bitcoin has been on quite the rally for most of this week. It was up 7% Monday, and it's rallying into its halving. Now, Bitcoin halving is happening on the 4th of April this year. Normally what we do see is that we get a bit of a pullback and a sort of a small rally into the halving, and then after the halving we get outsized returns. This has happened every single halving in all 4 halvings since 2011, and it's going to be really interesting. I think some people are even trying to price in what's going to happen after the halving with the rally. According to this data right here, I believe the source is CoinU. We should see Bitcoin at about 35,000 at the halving. That's I don't think we're going to get there seeing the strength in Bitcoin, but let's assume we're at a certain level. We then should see anywhere from like a 4.2x return or greater according to the stats here post the halving. And that could take Bitcoin to a minimum price of about 147, and it's trading at least at about 50,000, 55,000 right now. So there is significant upside to the halving in Bitcoin. Just something to note there, guys. Just some very interesting data. Now, guys, let's look at some seasonality. This is a very, very interesting chart right here, and it's the S&P 500 composite cycle for 2024. And it includes every year ending in a 4, every election year, and every year between 1950 to 2023. And what are the returns you can expect? Now, we are looking at the left scale right here. So we are looking at about, maybe let's call it an 8% return in total for the year. We're actually probably sitting at about 8% right now because this is the left scale. And if we are to follow the scale on a beta adjusted basis, we would actually get to a 44% return. Now, do I think we're actually going to get there? No, because a 44% return from where the S&P 500 is right now would take us to 7,300. That is just ridiculous. The S&P 500 would trade at like a PE above 30, maybe even 32 or 33. Absolutely ridiculous. That's not going to happen. That being said, it is good to look at cycles like this just to see where we are in the process. And generally speaking, this composite cycle does produce very linear returns for the most part, with some volatility here in May, some volatility here in the October region. These are areas actually where we normally get volatility for the most part. But looking at something more realistically, we could see this is the S&P 500 election years versus 2024. And for the most part, we are actually tracking in line with most election years. You could see that this red line is us 2024 right there, and every other election year. Now, this yellow line, this is 2008. This green line right here, it's either 2000 or 1952. But for the most part, every single election year tends to be very, very positive. And we aren't even traveling at the best election year. Normally, we're sort of like in the middle of the road in terms of the positive election years. And so we can actually expect further returns, probably anywhere from, I would say, between 10 and 20% in this cycle for the rest of the year, which means more upside. And it'd be even better if we could maybe like pull back, buy some dips, and then go. That's just going to further increase your year-to-date gains. Now, carrying on with the seasonal trend, a positive January and February is a good thing for 2024. Now, this is the S&P 500 performance for the year based on if January and February are higher. And what can we expect? An average return for the full year, 9.87%. But do take into consideration, we've pretty much brought forward a lot of these gains already. So you would have to minus January and February's gains from this number. That being said, on a full year basis, when January and February are higher, you can expect 18.7% return right there. Now, every single week, I show you institutional charts from BOFA, and we're going to do the exact same thing. I got a bunch of charts for you to show you guys this week, but we're going to start with this one right here. This is the S&P 500 JIX level 1 sector weekly relative rotation graph. So it pretty much shows us what sectors are improving, leading, weakening, or lagging. You can see here that the leading sectors are comm services and technology. Weakening is financials, and then lagging sectors are energy, real estate, utilities, materials, discretionary, and industrials are improving along with staples and healthcare. So this just gives you a great idea what really you should be holding now right here, and what probably you could be holding, and maybe what you should really be looking at maybe trimming in your portfolio. That being said, just data, and it doesn't really tell us anything in the future. It just tells us what's happening right now. Now, this is the Euro Stoxx 50 weekly chart with moving averages, and it's just some very basic technical analysis right here. You could see that we have a cup, we have a handle, and a breakout on a measured move takes us to the 5,500 area. On the low end, we're looking at 5,230, 5,360 here in the Stoxx 50, and these are just the biggest stocks in Europe, and they include names like Nestle, ASML, Sanofi, SAT Technologies, LVMH, Christian Dior, Hermes, Race, Ferrari. Great stocks to have in this index right here, and this is very, very bullish. You can see this breakout is extremely strong. We even did get a retest, a successful retest, and we can actually look to higher price action. I mean, even a little bit of a retest back there, moving higher to the 52, 53, and then ultimately 5,500 area. Now, it's not to say we're going to get there in a week, but 3 months, 6 months, 12 months out, you can look at these levels in between here. Now, looking at the next chart, the DAX index, very similar situation. We got a cup, we got a handle. We just started breaking out after this retest, and a measured move from the bottom of the handle to the breakout area takes us to 20,700 in the DAX, but lower levels can be 19,200 and 20,000 flat. And again, maybe we pull back, have a breakout. That's going to be super, super healthy. And a lot of these charts are backed by earnings. Looking at the Nikkei 225, absolutely incredible strength right here. And you can see that the NK JPY sort of has these breakouts, right, from these big bases. And then whenever you do a measured move, where does it take you to? Now, the measured move took the Nikkei 225, 37,000. We're actually well above that. So maybe we pull back and form another base to go higher. But the Nikkei 225 is looking very, very strong, especially with what we're seeing in Japan, as well as the earnings, like I showed you previously in the video. Japan's analyst earnings have actually seen upward revisions, which is very, very rare. Now, looking at topics, according to BOFA, it has some room to run to its 1989 peak at 288650. And you can see this big base forming right here, and the relative strength will take us right to this highs made here in 1989. Can we get there? Absolutely. I don't doubt it. There will be volatility on the way, but according to BOFA, it definitely has some room to run, especially with the earnings. Maybe we get a pullback and move all the way up. That's kind of a theme in these charts. And I'm not talking like a 10% pullback. I'm talking like a very mild pullback. It might even be a pullback in time, a correction as time moves forward, just a bit of consolidation. That's a pullback, especially on an earnings basis, and then we can rally to these highs. Index. Now, looking at the IBOV in Brazil, the weekly chart with moving averages, very similar situation to what we're seeing in a lot of the other charts. We got a cup right here, we got a handle, a breakout, and a measured move takes us to 148k. Although the index is starting to stall out right here, but maybe we're just getting a bit of a consolidation before the next push. On the lower levels, we can go to 137 to 138,000 here in the IBOV. So if you want to hold real volatility, you can get into this index. Just make sure you get a currency hedged version just to protect your capital in that sense. Now, looking at the HSI China shares, it's looking real rough for China at the moment. So I'm just going to read this straight for you guys. The HSI dropped to 14,794 in late January to retest the late 2022 low near the 14,597 area. The ensuing upside reversal above 16,335 and 59.72, which is first support, is tactically bullish with upside potential to 17,135 next, and potentially higher into chart resistance at 18,235 and the August 2023 downside gap at 18,792 to 19,030. So they're saying pretty much because we've bounced back from these lows, we can actually look at levels at 17,135, 18,000, and then up to 19,000, assuming this tactically bullish setup does prevail. Now, the Chinese regulators are doing a lot to support the stock market, and we could actually see further upside. China's also trading at a deep discount, but it is really hard to hold Chinese shares considering the business and economic environment that the CCP instills. You know, they do allow for capitalism, but it's heavily regulated, and if they don't like what you're doing, you're out of there. So that is not really supportive for constructive business activity. That being said, on a technical basis, this chart does look like it's going to go higher, and you know, all pullbacks, especially if we retest, we can look as high as 19,000 again, looking 3, 6, 12 months out. Now, data in the week ahead, guys, we've already parred some of these data points right here, but again, the big ones, PCE, GDP data this week, as well as consumer sentiment. We also have like ISM numbers, construction spend, but overall, the PCE, it's the Fed's preferred gauge of inflation. This is what the whole market is going to react to this week, and it's releasing on Thursday. We also have a bunch of Fed speakers. You can have a look at it here. Really good to see what they're going to say, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, guys, and leave a comment. Cheers.